Okay, so this is our presentation, and it's about the 520s, which was a Civil War issued bond. And I am working today with Jihan.
So just diving right into it, first we'll take a look at the bond history and its features. The 520s bonds were US Treasury bonds that were issued to help finance the Union war effort, including things like supplies, equipment, and salaries of soldiers. The name itself, 520s, came from the bond's nature of maturity. So it was a 20-year maturity period that could be redeemed after 5 years. It also paid a 6% coupon rate and was authorized for a total amount of about $500 million at the time. Congress, however, was able to come towards an agreement to pay these coupons in specie, but they left the conversation surrounding the redemption of the par value to be decided on a later date. As advertised by Jay Cook, who had exclusive access to brokering the bonds to be redeemed with specie as opposed to lawful money, which traded substantially lower at the time.
Unlike financing efforts of previous wars, the Civil War was focused on selling government debt to the public rather than conventional investors like banks or foreign nations. And this was mainly due to two developments. So, first, due to the actions of previous administrations that had undermined national credit, the government faced significant challenges in selling securities. And when it did manage to issue bonds late in the 1860s, it had to offer high interest rates of around 12% to attract buyers. And as a result, the 520s struggled to find a market among banks given the scale of the debts and the comparatively high interest rates. And on the other hand, there is no foreign markets for the 520s. Many British financiers and their clients had substantial investments in the South, particularly in the slavery and cotton production. And as a result, they were hesitant to invest heavily in American debt during the Civil War, leading to an underdeveloped market. And France exhibited similar reluctance because Napoleon III prohibited the sales of US bonds on the Paris Stock Exchange because he hoped for Confederate victory, which he believed might provide a strategic ally and a buffer against a divided United States. So without the backing from financial markets in London or Paris, the US faced limited foreign investment opportunities. And given these circumstances, the 520s were chiefly marketed towards the public instead. For example, some advertising operations offered free coffee and donuts to those who were willing to listen to the benefits of investing in the bonds. And these events specifically targeted those of the working class who were either coming off or going on shift in the late nights or early morning hours. All right, so to better bring to life the 520s bonds, we decided to create a graph of quantity over time and map certain historical events to changes in this graph. So the first thing we see when we look at this graph is a plateau from February 25th to May 1st. And this was because of the aforementioned lack of interest from banks. The interest rate offered, which was 6%, was way too low, and the government struggled to sell off debt to foreign nations like Britain and France, who closed off markets to union bonds. And thus, the sales of 520s was really slow in the first 6 months of issuance, with only 2.5 million of the 500 million authorized being sold. But this changed, as you can see, from May 1st to July 30th, where bond sales rapidly rose. And this owed to three different events. First, Simon Chase requested the Koch brothers to lobby and pass the National Banking Acts of 1863. And the National Banking Act required national banks to issue notes backed by federal rather than state bonds. And this in turn created enormous demand for the 520 bonds in the subsequent months. Moreover, Jay Cook was also given exclusive access to broker the bonds, and through his 3,000 different salesmen and his brother's media connections, he marketed the debt to the public using patriotic appeals. Lastly, Jay also increased public confidence in the bonds. In the March of 1863, when the 520s were trading at 94 and a half of the par value, Jay Cook bought every bond selling below par value to boost the government's credit. And as a result, the bond sales increased dramatically to 1 million a day in the subsequent weeks. This increase in demand was so tremendous that Jay wrote, the great difficulty was to obtain enough bonds from the Treasury Department, which in turn was unable to get deliveries from the printers and engravers. The second rise in bond sales was during July 30th and September 1st. And during that time period, the Union emerged victorious in the Battle of Gettysburg, which was a major turning point in the war. And in contrast to previously slow developments in the war, the Battle of Gettysburg signaled to investors of a nearing Union victory. The quicker the war ends, the earlier the government can stop borrowing and begin to pay back loans, which is why the 520s increased both in price and bond sales during this time. At the same time, around July 1st of 1863, legal tender notes could no longer be converted into 520s, and thus newspapers around the country, but predominantly those owned and influenced by the Cook brothers, began to frame buying the 520s as a last chance to cash in on such a deal, because after this date, they can only be bought in gold, which was considerably more valuable than greenbacks. We also created a prices over time graph, and what we see immediately when we look at this graph is a long-term upwards trend. So in the first few years upon issuance, the climb in prices was because the 520s was seen as a method of currency exchange, and this was because the 520s could be purchased in greenbacks, but was advertised to be redeemable in gold. Thus, as the value of greenbacks depreciated, the prices of the 520s rose. And in later years, starting from the 1870s, as interest rates fell to around 4.5 to 5%, that made the 520s a more attractive investment because it offered a 6% interest rate. We also mapped certain historical events to changes in bond prices. And the first thing we see is on January 8th of 1863, Congress announced a $300 million increase in greenbacks, likely causing inflation and devaluing greenbacks compared to species. As 520s were bought with greenbacks but advertised as redeemable in species, their value would rise as greenbacks lost value, hence a massive increase in prices. But then on April 27th of 1863, which is point 2 on the graph, the Confederate Treasury Note Act was passed, which authorized the issuance of interest-bearing treasury notes known as the 6% non-taxable bonds. These, coupled with a series of Union defeats in April, such as the Battle of Plymouth, as well as tumultuous political developments in the Union, like the proclamation of amnesty, this could have resulted in investors preferring Southern bonds and thus crowding out investments for the 520s. Lastly, what we see on point 3 and the rise in prices was because on June 3rd of 1864, the National Banking Act was signed with revisions from the earlier Act of 1863. The biggest difference was now that New York City banks, which held the lion's share of the nation's capital, were now compliant with the National Banking Act, which means they also had to buy 520s to back their issued notes. And as a result, demand for 520s increased and prices increased as well. Two more notable events are the Public Credit Act of 1869, which assured that all U.S. government bonds, including the 520s, would be repaid in gold rather than depreciated greenbacks. This guarantee increased investor confidence, making the 520s more valuable since the repayment in gold was more certain, leading to a rise in prices. Also, the Panic of 1873 led to widespread bank failures. As banks collapsed, the financial systems became unstable, leading to a lack of confidence in various financial instruments, including the 520s. And this panic triggered a stock market crash, which caused investors to liquidate assets rapidly, including the 520 bonds, to cover losses and maintain liquidity, which is why we see such a steep drop off in prices.
Now, taking a look at the debates during bond redemption period, the decision to actually redeem the 520s had a lot of economic implications. For example, redeeming these bonds in gold would actually bolster government credit, which made debt-free financing more affordable. And even though that was during lower interest rates, conversely, redemption in greenbacks would actually create immediate savings on government expenditures at the expense of government credit. So those would be the two sides of the debate.
The push to redeem the 520s in greenbacks rather than gold came primarily from Western states. The Western economy faced a chronic scarcity of gold in specie because of the war, as much of the hard currency had been drained to the east or out of circulation, creating a credit crunch. The economic struggles were made worse by crop failures, competition with older agricultural regions, and manipulative railroad rates controlled by Eastern interests. In this context, Western farmers saw the redemption of bonds and greenbacks as a practical solution to the financial troubles. By redeeming bonds with greenbacks, the government will likely print more money, thus injecting additional money into the economy. Because greenbacks were not supported by gold, printing more of them would lead to a rise in the total money supply. This increase in money flow would supply essential liquidity to an economy lacking in hard currency. Conversely, redeeming 520s and gold would further worsen the credit crunch by placing gold into the hands of bondholders, most of which were concentrated in the Northeast. Moreover, many Westerners, particularly farmers, were deeply in debt. They owed money in the form of mortgages and loans that had to be repaid in hard currency. If the government redeemed the bonds in gold, it would drive up the value of gold relative to greenbacks, further increasing the debt burden. And by redeeming the bonds in greenbacks, which was less valuable than gold, debtors would effectively reduce the amount they owed in real terms, easing the financial pressures. Politically, these interests were represented by figures like Washington McLean, the boss of Hamilton County, who controlled the influential Cincinnati Daily Inquirer. McLean and his allies sought to capitalize on Western discontent with a Northeastern dominated financial system.
Now, going back to our main questions for this research, for example, who wanted the 520s to be redeemed in gold? We mentioned prominent banker Jay Cook a lot, who was a strong redeeming these bonds in gold. As a salesman, he confidently promoted the idea that, and I quote, Congress has provided the bonds and shall be paid in gold when due. So, with his reputation at stake, it's very likely that Cook actually leveraged his extensive political and media connections to push for legislation that mandated that government bonds would be paid back in gold. Now, that's good, but moreover, because of Cook's advertising efforts, which targeted the wrong working class or the wrong class itself, there was significant public support for redemption of these 520s in gold. Next, now going back to our main questions for this research, for example, who wanted the 520s to be redeemed in gold? We mentioned prominent banker Jay Cook a lot, who was a strong redeeming these bonds in gold. As a salesman, he confidently promoted the idea that, and I quote, Congress has provided the bonds and shall be paid in gold when due. So, with his reputation at stake, it's very likely that Cook actually leveraged his extensive political and media connections to push for legislation that mandated that government bonds would be paid back in gold. Now, that's good, but moreover, because of Cook's advertising efforts, which targeted the wrong working class or the wrong class itself, there was significant public support for redemption of these 520s in gold. Next, what was the impact of 520s on the overall economic situation? So, despite the method of redemption for the 520s bonds and how unstable it made the economy, it did give holders of these greenbacks a probability that their value as investors would be devalued. And as a result, consumer confidence and spending were reduced. The vague defined character of bond redemption terms increased the effective sovereign risk and further depressed overall market confidence in the US government debt and generated skepticism about future economic policies. But there's a silver lining, as fortunately, the enactment of the 1869 Public Credit Act, which required government bonds to be redeemed in gold instead of greenbacks, it restored confidence among both domestic and international investors. Now, this reduction in the risk premium for the US government securities not only lowered interest rates, leading to the refinancing of remaining bonds by 1870, but also by high margins. So, for example, 4.5% with 30-year bonds and 4% with 5-year bonds. And then by 1877, all the 520 bonds had been completely redeemed. Hi, this is Jihan Kapoor, and I'm going to pick back up on economic theory in the 520s. So first, how exactly was the issuance of these bonds consistent with Ricardian equivalence? So this holds that borrowing by the government finances expenditures that doesn't actually change the aggregate demand level of an economy. This is because people can predict these future taxes to be paid in order to meet the said debt amount and then increase their savings to be able to pay tax liabilities in the future. Now, in terms of our research, I think there's two key points to touch on. First would be higher savings, right? The issuance of these bonds might have actually made people save more in anticipation of future taxes to pay off these bonds. Next, neutral effect on demand. If everybody saved as much issued debt as they could, it would have a neutral effect on aggregate demand. So in this scenario, the bonds would not lead to an increase in demand as people would have to prepare for tax increases in the long run. Where confronted with a lot of 520s bonds, investors would realize that at some time in the future, the government actually has to pay for this indebtedness, so to speak. So next, we have the idea of public choice theory and how exactly political ideologies serve as mediums for lobbying efforts. So if you don't already know, public choice theory applies the principles of economics to political processes. It's focusing on things like self-interest, incentives, and things of that nature. So first, interest groups and self-interest. So there's a lot of different types of interest groups involved when looking at the 520s. typically bondholders who wanted payment in gold for better returns, and some who wanted it in legal tender to reduce the fiscal burden on the government. So it was all in self-interest. We also had incentives to politicians because politicians would either tailor their support to either one side or the other based on the benefits associated with securing votes on either side. And one thing we definitely don't want to leave out is the intense lobbying efforts that these groups would have as they represent specific bondholders. Conversely, people who cared about fiscal sustainability or inflation might push for things like payment and legal tender. And again, on the other side, that would be for gold for their own self-interest. And then lastly, we want to look at how exactly the term structure of 520's interest rates compared with contemporary yield curves, and what can one person think when they think about the future of interest rates and inflation from yield differentials between 520's bonds and today's time. So the term structure of interest rates themselves, or the yield curve, it actually depicts the relationship of interest rates or bond yields to different types of maturities. For example, the 520s bonds could be compared with other government securities that they had at the time with different maturities, and you could compare interest rates like that. So specifically, first we could look at the comparison of the yield curve. So at that period, the 520s bonds would have most likely have yielded more than short-term government securities due to their higher rates of maturity and associated risk for investors, as a steeper yield indicates higher future interest rates and a flatter one has lower, right? Inflation expectations also, if yields on the 520s bonds were higher, expectations of future inflation would actually be a reason for that. And then lastly, risk perception. The yield differential also gives clues to these investors, as a large gap between the 520 bond yield and the yield on shorter term securities at the time could actually indicate a perceived risk associated with the long-term debt. So this could be the result of fear about government creditworthiness or just the instability of the government at the time. So just to conclude, it was the 1869 decision to repay the government in bonds and gold that helped restore confidence in the eyes of domestic investors at the time. It reduced the risk premium on the US bonds, which showed everybody that we have improved investor confidence. But it was a gradual reduction because a lot of outstanding bonds and stabilizing bond prices, it was a lot of work for the time. But what this did was it set the stage for effective economic stabilization in the future and repaid in gold, as you know, that was a crucial monetary policy that positively influenced inflation expectations and currency stability. And yeah, so that is the second half of the presentation. Here are the sources used, and these on the bottom are specifically for economic theory. Thank you.